Hello everyone, and welcome to our discussion on preparing financial reports in Design Manager for your company year-end. My name is Brad, and I'll be hosting a demonstration today. If you have questions during the webinar, feel free to enter them into the questions pane under GoToWebinar panel. If the question is outside of the scope of today's discussion, please email them to support@designmanager.com. Lastly, if you miss a portion of the webinar or want to review any of our past discussions, you can go to our Help Center at knowledge.designmanager.com. Click on the Webinars menu and select Recorded Webinars, and you can review any of our recent past discussions. You can also go to our YouTube channel at Design Manager Inc., Design Manager INC, where you can see any of our recorded tutorials or webinars and review them at your leisure. Now, today we'll be discussing the reports that are most commonly required by your accounting professional and needed by yourself to properly file year-end taxes. We will not, however, be focusing on how to remove entries from the reports, as these procedures are covered at length in two of our other webinars, our 5 monthly reports to review and fixing common accounting issues. I highly suggest reviewing both of those webinars at your leisure to really get a deep understanding on some of the topics we'll be covering today. As the reports are nearly identical in both platforms, I'll be running examples in both Design Manager Cloud and Design Manager Professional Cloud, so users of both versions can see how to access the various reports in their familiar program. Before getting into the reports themselves, let's go over a few tips to really keep yourself organized and prepared for year-end reporting. As I just alluded, many of the reports should be run on a monthly basis at a minimum. When I do so, I like to maintain a copy of them for each month of the year so I can review them retroactively if any particular count may have changed. To facilitate this process, I've created a folder on my computer for 2016. Within my 2016 folder, I have two more folders, one for monthly reports and one for year-end reports. In our monthly reports, I've even created 12 subfolders, one for each of the months of the year. And as I run my reports at the end of the month, I export them right into each of the appropriate folders, and so I have them so that I can review them at any time in the future. And we'll go over exporting a report towards the end of the demonstration today. Having the reports saved at the moment you run them or ran them is particularly convenient. By default, Design Manager has a timestamp on each report. What do I mean by that? Let's look at one of the reports we'll be going over today. Under Reports, Accounts Payable, the Aged Accounts Payable report. If we run this, focus in the top right quadrant, we can see a printed date and time. This notes the exact day and moment that we printed the report. Well, why is this a handy feature? Let's imagine that we were reviewing our July aged accounts payable and we ran the report sometime in August. And then I run the report again today like we just did. If any of the values or transactions on that July report are different on the one I ran in August versus the one I ran right now, I know that some transaction was either added, deleted, or edited 4 months up to and including July, but it occurred sometime between now and the moment I ran the report in August. So it's a very handy tool to begin having our evidence to track down what transactions have changed. And obviously, we generally don't want to change information for prior fiscal months. Now, my suggested folder layout, that's just something that I've come up with. Anything that works for your company can be used. Just do so consistently and accurately, and you'll have all the necessary reports that are going to be required by your accounting professional at the year end. Looking at our reports window, we have another convenient tip. I like to have all of my necessary reports already saved in my favorites area on the report window. Now in Design Manager Cloud, we have a tab for our favorites, and we can add our commonly used reports there very easy, and we can then access them quite quickly without having to hunt through all of the hundreds of reports that we have there listed. How do we do that? Very simple. Just find the report that you may like our aged accounts payable, and just click the Add to Favorites button. Doing so puts it right on our Favorites tab, so we can go to our Favorite Report tab and have a list of all of our reports that we commonly use. Now you can even get more sophisticated by adding folders under the favorites to which we can add the reports. So I could add a folder by clicking the New Folder button, and I might have one for monthly reports. And if I want to include my reports into that particular subfolder, I would just have it highlighted on our Favorites tab. And let's take Work in Process as an example and click Add to Favorites. And now we can see it underneath our monthly reports. So I might want to rearrange my Aged Accounts Payable report so that I can place it as well under my monthly report. And I might as well go and add all the other reports we'll be accessing today, including our Aged Accounts Receivable, our Open Client Deposit, our Open Vendor Deposit, along with a few financial reports, including our balance sheet, our yearly income statement, and even a report known as our trial balance. And there they all are. For our professional users, you have the same functionality as well. If we look over at our professional platform, at our report window, the favorites, unlike Design Manager Cloud having a tab, it's simply split on the reports window itself. And I've already included the same exact array of reports in our monthly report folder. Now that we've discussed some tips in getting organized for year-end reporting, let's begin discussing the reports themselves. At a minimum, you're going to need your income statement, balance sheet, and trial balance. Let's go ahead and take a look at some of those. Let's begin with the income statement. Now the income statement, also known as the profit and loss statement, measures the company's financial performance for the year by summarizing the sales or revenue, the cost of goods sold, and expenses for both client-related and non-client-related activities. The income statement is found under our General Ledger Reports folder, under our Financial Statements folder, and it even has its own subfolder for income statements. And we can see we have a few different options here. I just display the income statement depending on your desired time frame. And we can see we have monthly, quarterly, yearly, and the comparative income statement. In brief, the monthly is going to show the account balances for the selected month and the year-to-date totals. So if we quickly print that, we can see here's our sales and revenue, cost of goods sold, operating expenses for the selected month, and the year-to-date totals. The quarterly allows us to select a 3-month range, which will show the quarter in question, and again, the year-to-date totals. The yearly is just going to show us all of the activity for the current year. And there it is. And lastly, the comparative income statement. This allows you to select a calendar date range and compare it against another date range. So you can monitor performance from one quarter to another, or one half of a month to another half of a month, or how did you do in January of 2015 versus January of 2016, etc. So we could run this, let's say, for July 1st through the end of July, August 1st to the end of August, and now we have our ranges where we're comparing those two periods and whether or not we're increasing or decreasing the accounts, and the appropriate percentage change. A very handy tool when analyzing business trends. But for our year-end discussion, let's focus on the yearly version, as that's what your accountant is most likely going to require. So we'll print that for the current year, it being the end of the year, and here we go. So let's take a look at our income statement in a bit more depth. Again, first we have our sales or revenue accounts, and these accounts get affected on our revenue when we actually invoice our client for our goods and services. And these are all of our revenue accounts that have activity in the year. Next, we have our cost of goods sold, also known as COGS. These accounts get activity input into them when we actually record vendor invoices on project purchase orders, or for our professional cloud users when you sell your inventory. And this activity is usually realized after the merchandise has been invoiced to the client, which moves the cost out of work in process or inventory into the appropriate cost of goods sold account. And lastly, we have expenses, operating expenses, and these are generally non-project related expenditures necessary to run the business itself. Insurance, rent or mortgage payments, office supplies, etc. Now, a very common question that we get in our technical support department is how certain revenue and cost of goods sold accounts get determined when invoicing a client and recording invoices from your vendor. That is discussed at length in another one of our webinars known as the sales category, or also called our sales category and general ledger accounts webinar, and I go into great detail on how activity goes into those particular revenue and cost of goods sold accounts. So if you have any questions on that, I highly recommend checking that out. And that is our income statement, or our profit and loss statement. Your accountant or accounting professional will definitely want a copy of that at year end. And if that's analyzing our net income for the year, the flip side of our accounting model would be recorded under our balance sheet. Now, the balance sheet is used to display the overall financial health or worth of the company by analyzing the assets of the company against the liabilities and equity. Let's go ahead and print that. We'll print that for the end of the year. And we can see listed at the top, we have all of our asset accounts, and then we have our liabilities and equities at the bottom of the report. Assets are going to be areas of value within the company, cash, accounts receivable, work in process, equipment, etc. Liabilities are going to be areas or sources that withdraw value from the company. Accounts payable, or bills that we owe, sales tax that we've collected that we have not yet paid our sales tax authorities on, credit card debt, etc. would all be examples of liabilities. While equity is perhaps the most difficult concept on the balance sheet, and that's really the accumulated, what they call capital employed of the company. And it really represents the essential net worth of the company. Effectively, you can think of it as the area where the owners or the ownership of the company has withdrawn assets. So this would be considered the owners taking out worth of the company, either as stock, as owners draw, as income or retained earnings, is what gets evaluated in our equity accounts. Now notice, we have our current year income listed on our balance sheet. That should always match the net income on our yearly income statement. And we can see it on our P&L right here, $7,652, which does indeed match it on our balance sheet. So that is a tying agent between the two reports. A third report that your accounting professional will most likely ask for is what we know as the trial balance. Also under our general ledger, but not under financial statements, we can see our trial balance. Again, I've already attached that to our favorite reports as I go to it time and time again. Now we'll run that for the end of the year. And while it's accumulating, let's discuss the trial balance. This lists all of the accounts and their current balance, and essentially it consolidates the information from the income statement and the balance sheet onto a single report. And if we look, we can see all of our assets in the tens or the 10,000 range, which is traditional for our assets. Next, we can see our liabilities in the 20s or 20,000s. Third, we see our equity accounts in the 30s or our 30,000s, followed by our revenue accounts in the 40s, our cost of goods sold accounts in the 50s, and lastly, our expense accounts generally in the 60s or 60,000 range. So the report on the trial balance, the first three areas are all of our balance sheet accounts: assets, liabilities, equity. The second half is going to be all of our income statement accounts: revenue, cost of goods sold, and our expenses. Now, asset, cost of goods sold, and expense accounts usually maintain debit balances, which is the first column. And you can see here's our furniture, cost of goods sold account, our office rent expense account, and our cash checking asset account, all maintaining debit balances. Conversely, revenue or sales, liabilities, and equity accounts generally have credit balances naturally. So we can see our American Express bill, our sales tax collected for our liabilities, maintaining a credit balance. All of our revenue accounts, such as our furniture and lighting, they also maintain credit balances, as do any of our equity accounts, such as our common stock and our retained earnings. So 3 sets of accounts maintain debit balances and 3 maintain credit balances in their natural configuration. At the end of the report, we're going to have our summated or net debits and net credits. Those two numbers should always match, because every transaction must debit one or more accounts for the same amount that it credits one or more accounts. You'll hear in accounting terms the net debits and credits for a particular transaction, and our overall trial balance must always match. Okay. In accrual accounting, which is the model that Design Manager utilizes and is recommended for interior design firms, the balance sheet also displays information for a few very specialized accounts. Let's go back there briefly, and we'll take a look at some of those special accounts. And they include our accounts receivable, make this a little bit bigger, our accounts receivable, our vendor deposits, and our work in process in our assets area, and in our liabilities, our accounts payable and our client deposit. These 5 accounts have very useful and very specific functions in the accrual model. And they're often referred to as subsidiary accounts, and there is coincidingly subsidiary journals that provide information upon each of those specialized accounts. And I've also included those in our monthly reports. Accounts receivable, work in process, vendor deposits, and then we have our accounts payable and our client deposit. Those 5 reports, and in turn the accounts themselves, if they're monitored on a timely basis and the information on them is accurate, well, we can be fairly confident that our balance sheet is accurate. If the balance sheet is accurate, we have a very good indication that our income statement and trial balance will be accurate as well. So it's really setting the foundation of our accounting model by reviewing these reports and then trusting that if the reports are accurate, our accounting information as a whole is going to be accurate as well. So let's briefly describe each of these reports, as they're often needed for year-end review. Again, these are described in detail in our 5 monthly reports to review webinar, where I also go over how to remove transactions from those reports, and what potential pitfalls may occur on those reports as well. So let's examine them sort of in the overall order of the design process, starting with the open client deposit. The open client deposit report, this is going to display deposits on proposals and retainers that we've recorded from our client, but we've not yet applied them to a client invoice. The report's also going to show client invoice transactions that utilize retainers and deposits as well. It can be considered as a physical representation of the activity that's held in that client deposit liability account that we just saw on our balance sheet. It's a liability because technically the funds still belong to the client. They could at any time really ask for that money back if the design process falters or they simply change their mind. Effectively think of a deposit or a retainer as you just holding the client's money until it is ultimately utilized or applied to a client invoice. Let's go ahead and take a look at the report. Here we go. Let's make this a little larger as well. Let's take a look at some of the transactions on here. Now, I purposely kept it somewhat simple just for clarity today. So we can see that our Carter's Pennington Home project has a retainer of $5,000. Our Hilson project has both a retainer and a deposit applied on proposal 1, while our Carter's Brigantine Beach home has a little bit more activity. We have one retainer and we have a deposit on proposal 1 and 2 deposits on proposal 2. So we've received stages of our deposits there. And we can also see deposit applied transactions. These represent the portion of deposit actually being utilized on invoices 10,003 and 10,004 correspondingly. And this is the total of the client. Now, the very observant of you might notice that if we look at those 2 deposit applied figures, 1608.20 and 1050.25, that actually matches the deposit we received on proposal 1 exactly. Now, if we had simply made one invoice that utilized that entire 2658.45, the deposit itself and the deposit applied transactions would simply drop off the report. We had the deposit, it got utilized, it would drop. Since the amounts came in 2 phases or more phases, once the entire client amount drops to 0, all of the entries will drop or quote-unquote close. Design Manager doesn't go out and add up each individual deposit applied transaction and try to match it against deposits received, as that is just simply not practical. So what if we find transactions on this report that are incorrect? Well, why would these be considered problematic? First, technically we're understating the value of the company. We're maintaining this entire 633.12 as a liability. It looks like to anyone analyzing our balance sheet that we've received these deposits in but have not yet converted them into revenue, into net income. And the client could, or all the clients could ask for those funds back, which would really, of course, hinder cash flow and hinder the worth of the company. Another issue, we could be neglecting to pay sales tax. Remember, in our accrual accounting model, sales tax is due upon invoicing the client. We may have even gotten all of the money for a proposal up front, but until we make that client invoice, even if the balance due is 0, quite frankly, there is no invoice, there's no sales tax accrued. Nothing would appear on our sales tax report in Design Manager, and in line with that, we're not going to be paying our sales tax authorities those funds, which if we get audited, that would be quite problematic. And in a moral sense, we simply may owe the client back some funds. If we never applied the $5,000 retainer for the Carters to design services or other invoices, well, technically we may actually owe them those funds and want to contact them to see if we owe them money back or if they want to apply to future services, etc. So there's a lot of reasons why this report should be analyzed on a monthly basis, particularly at the end of the year. Let's take a look at a few of these transactions. Maybe we can spot something that may look sort of out of line. And here's one. Under our Hilson project, I can see this deposit is all the way back from 2015. And that's for $8,323.12. If we take a moment and look at our Hilson project in our documents in accounting, I can see the entire proposal was for the exact same amount. So the client gave us all of the funds up front, and this is one of the examples I was just alluding to. Sure, they gave us the money, but we have not yet invoiced it. We haven't paid sales tax on that. We haven't done any, we haven't accrued any of our income, etc. So that needs to be handled appropriately. Doing so, we would actually just invoice the client for those goods and services. Yes, the balance due may be zero, but we'll drop it off the report. But there are considerations there as well. Now, I perhaps should have invoiced this last year. I certainly can't do that now. Presumably, I've already paid and filed my taxes for 2015, so I'd never want to disturb any accounts and the account balances of that year. Otherwise, my financial reports will no longer match what I filed my taxes upon, which is generally not a advantageous situation. So I'd have to make my invoice into this year. The concerns there are, well, yes, I'm making the invoice. I'm going to drop my deposit off of this report, but I will be accruing some net income, which I will eventually be owed. I will owe income tax upon when I file for 2016. So even though I should have paid taxes on this this year for 2015, now I'm going to owe it when I file in 2017. So I'm going to get hit for some income tax there. I'm also going to be liable for the sales tax. So I had better invoice this into a month where I haven't filed my sales tax yet, such as the current month, of course, because I'm going to need to remit sales tax if that applies in your locale. So whenever we're trying to clean up or remove entries from these reports, we need to think of some of these considerations, which I'll point out upon each of our reports. Okay. Now, let's think about, so we have our client deposit, that's us getting funds from the client. Perhaps the next step in the design cycle would be us sending any deposits necessary to vendors. Let's jump over to the professional platform for that one. And this would be our open vendor deposit. Vendor deposits are the initial funds for the vendor, so they begin processing an order. And the open vendor deposit report shows us all of these deposits on project and inventory purchase orders in the Pro platform that we've not yet applied to a vendor invoice or a final vendor invoice for that purchase order. The report will show vendor invoices that utilize a portion of the original vendor deposit, which leaves a balance of the deposit still available, and it will remain there until the entire deposit is applied to a vendor invoice. This report represents the activity on our vendor deposit asset account. Now, this account's an asset because the goods and services technically are still the vendors at this point. We're providing them upfront funds to begin processing the order, but that money is technically still ours. Just like we were holding the money for our clients on our client deposit account, the vendors are holding our money for vendor deposits. And in turn, we could technically ask for those funds back. And as I said, the activity will remain on the report until we use the full deposit on a future vendor invoice. And that represents us taking ownership of that good or service from the vendor. Our company now owns it. At that point, the activity is going to move out of the vendor deposits into work in process or cost of goods sold, depending on the scenario. So, all that aside, let's take a look at the report. And we'll make that a little larger for viewing. And here we go. Let's take a look at some of these transactions here, and these all look pretty straightforward. We can see that we have a deposit for curtain calls workroom of $200, Philip Jeffries, we have a deposit on a purchase order as well for $360. Our legacy antiques, we have a deposit on one purchase order, and then we can see our purchase order for one of our Carter projects. We have a deposit, and this transaction represents us recording a vendor invoice that used $1,100 out of the $1,900 that we placed upon that purchase order. When we eventually get bills for the remainder of that purchase order, the entire transactions will drop off of there. So if we find information on this report that is incorrect, what does that, what's problematic about those such transactions? Well, if there's transactions on here that shouldn't be, we're actually overstating the net income of the company and perhaps the worth of the company. This is all going to be saved as an asset, so if someone's analyzing our balance sheet, they're going to see that we have these funds out with all these vendors, presumably for work or goods that were going to be coming in. Almost more importantly is we're overstating our net income. If we actually did receive the final bills for all of these transactions or some of these transactions, this activity, all of these costs should be converted into ultimately cost of goods sold to reduce our net income. Because right now, I may have even invoiced the client for some of these goods and services. So that gives us revenue, i.e. net income, without a corresponding offsetting balance in our cost of goods sold. Key point, one of the areas that we always recommend in our technical support department, when people call us asking for reasons why their net income is high or their cost of goods sold seems low, vendor deposits is the first place we often point them to make sure that those vendor deposits have been converted into cost of goods sold by having those final bills recorded, particularly in cases where the vendor asks you for full payment up front, or pro forma invoice they may call it, where you provide the entire order up front. That should be recorded as a vendor invoice. Otherwise, it can be sitting on our vendor deposit report and never hitting our cost of goods sold, again, which would result in us having a higher net income and correspondingly having paid taxes on that higher net income. If we do find a transaction on this report, perhaps the entire Philip Jeffries was $360, all I have to do is make a vendor invoice to move it off of that, and correspondingly I will have an increase in my cost of goods sold, which technically is quite good because now my net income will be going down. Vendor deposits, very important, particularly when we're reviewing our cost of goods sold. Next in our phases would be when those final bills start coming in from the vendors. That's going to represent our work in process. Let's jump over. Work in process report is also under our accounts payable reports. And there it is, work in process. Of course, I've attached that to our favorites as well. Now, the work in process, when we receive and record an invoice or bill from the vendor, by default, Design Manager record the cost of those goods or services first into our work in process asset account. And it's going to remain there until the client is invoiced for the goods or services. At that point, the costs will be relieved from work in process and move into cost of goods sold, as I've said already. The client invoice, in effect, represents the transfer of ownership from our company to the client. So when the vendor invoice represents us taking ownership of the product or service from the vendor, the client invoice represents us transferring the ownership of that good or service to the client themselves. Now, work in process is an asset account because your firm technically owns the good until the client is invoicing. Work in process can be conceptually considered as the company's inventory that's been allocated or earmarked to a particular project. We've purchased it on behalf of the client and we're holding it until we invoice the client. Work in process is such a critical component to the company's fiscal health that we have an entire webinar devoted solely to the subject. Again, you can view that on our Help Center, the recorded webinars, or our YouTube channel at Design Manager Inc., and it's simply called Work in Process. So let's take a look at the report and see what we will see. And there we go. And we can see some usual transactions here. For example, the Hilson's Pocono home, we simply have received the bill for a lot of the furniture on a particular purchase order, and it's simply waiting for us to invoice the client for those particular pieces. Now, Carter's Pennington home, we have a rush charge. Okay, that may be something we actually want to invoice the client for. We were billed $55 for the rush charge, and we want to pass that on to the client, so we would indeed wait to invoice the client. The Brigantine Beach home, however, let's say there's a restocking fee for canceled fabric. Maybe that's our mistake, and we will never invoice the client for it. Well, we don't want it saying on our work in process report forever. We want to convert that into cost of goods sold to keep this report accurate and to accurately reflect our cost of goods sold and ultimately our net income. Why would old or erroneous transactions be undesirable on this report? Well, obviously, you need to invoice your clients for merchandise or services, merchandise that you've purchased from your vendor or services that you provided in order to keep your cash flow at an appropriate level. And if there's going to be a balance due on that invoice, the client will still owe you money, so obviously we want to invoice on a timely basis. Further, you don't want to miss any incidental charges, such as this rush charge for the interlining or the restocking fee. These charges can have a really big effect on our net income if they're not reimbursed by the client. And even if they remain on the work in process report, we're overstating our net income and we're going to be taxed on that net income. And same if the vendor invoice simply wasn't moved properly out of work in process and is remaining here. Again, we're overstating that net income. So work in process, very important to keep an eye on. Entries get removed from here, again, simply by invoicing the client. But we need to think about that with some considerations here as well. Now, we might not want to invoice the client for the restocking fee. So I'd simply make an invoice for a zero balance to the client, but it would take that cost of goods sold out of there. So this would be a reduction in our net income. We'd have zero revenue being realized, but we would have that cost of goods sold. Technically a good thing, as our net income is going down, and we'll have a less of a tax liability there. If we do want to invoice the client, of course, it should be done in the current fiscal year, obviously, and in the appropriate calendar month so that we pay we accrue sales tax on it appropriately, etc. So work in process, critical report. And again, if so desired, view our webinar on the topic as I spend quite some time going into it in great detail. Next, aged accounts payable would be our next stop. This is going to be the balance that we owe on bills that we've recorded from the vendor, but we've not yet remitted payment. We can see that, of course, under our accounts payable folder, aged accounts payable. When we enter deposits, vendor invoices, operating expenses, etc., when they're entered, they first go into the accounts payable liability account, provided that they were not applied to a credit card, etc. And they'll remain there waiting for us to write a check or otherwise indicate a payment online, a wire transfer, etc. Now the accounts payable is a liability account, and that makes sense as the company is eventually going to be required to remit payment at some point to alleviate that debt. And the aged accounts payable report is an interesting report because that's one that tends not to have too many transactions on there that are incorrect. If you haven't paid your vendor in some time, they will usually let you know about that quite quickly. Ideally, the aged accounts payable report should match all of the transactions listed on our payments and check window. In Professional and in Design Manager Cloud, it would match on our checking window the Pay Bills Print Checks tab. So it's a printed representation of the entries that are on those two windows. Let's go ahead and take a look at the report. There we go. So we can see we have a variety of different transactions here. We have some operating expenses. So we have an expense to Federal Express. We have a couple of entries for our landlord for our rent, and then we have some vendor invoices on purchase orders. So we have one for America's Mattress, one for Century Furniture, and for our baker vendor, we can see we have the invoice itself, and we've paid half of that invoice via a hand check. So we've entered the entire bill, and we paid half so far. Once we pay the entire remainder of that vendor invoice, the entry would drop. And again, we can see that those match all the entries on our payments and checks window. Say we find some transactions that are incorrect on the accounts payable report. Why are they undesirable? Well, often duplicate transactions can be found on the aged accounts payable report. And this is going to be understating our net income and also devaluing our company. If someone's reviewing our balance sheet for a loan or potential investment, etc., if they see a large accounts payable activity or amount or balance, they're going to say that, well, the company owes a lot of money. They better be taking in tons of funds to cover that large amount of debt in accounts payable. It's also a marker against the strength of the company. If there's very old transactions on that report, that can indicate to a potential loan investment, etc., that we don't pay our bills on time, which either represents bad cash flow, bad accounting, bad bookkeeping, etc. So that becomes a pretty bad red flag on any of those considerations. And we can see, even right here, if we look at our landlord for the Princeton Real Estate Group, I've got 2 transactions for my November rent. Obviously, it was entered in twice, and it looks like that I now owe double. I imagine that I'll go to pay a check, or I'll write a check for one of these, but the other may stay there until I catch it, months down the line. And this would indicate that I have a liability that I truly don't have, and further, I have an expense recorded that that is incorrect. So I need to void or remove this transaction, which is going to lower my expenses and then increase my net income. Another consideration here, let's say I have a transaction that was in the prior fiscal year. If I had a transaction from 2015 that I wanted to remove, voiding a vendor invoice or vendor deposit in Design Manager always does so in the original fiscal month. So if I had a transaction from 2015 and I voided it, I'm immediately going to be affecting my 2015 financial statements unless I have Design Manager configured to block me to do so, which is undesirable. Again, as I said before, we don't want to change any of our fiscal information that we have filed our taxes upon. In those cases, I might actually need to enter in an offsetting transaction. So if I wanted to get rid of my American Mattress in 2017 and I didn't want to void it because I entered it in 2016, I would have to input a minus 1250 and then offset or clear both of the transactions from here. So it's very important when we're looking at our accounts payable report to remember that voiding a transaction will do so in the original fiscal period or fiscal month. And that brings us to our fifth and final of our 5-year end subsidiary journals, and that's going to be our aged accounts receivable report. Now that would be under accounts receivable, logically, and there's our aged accounts receivable. After we've begun to invoice our client for finalized goods and services, the balance of the client invoice remains in the accounts receivable asset account until the client gives us final payment. And this is an asset because the company has a firm and reasonable expectation that payment from the client will be received at some point. And we'd essentially convert that asset from accounts receivable into one of our cash or checking accounts. Let's take a look. And there we go. So we can take a look. These are going to be all of the invoices that we've created for our clients that we have not received payment in full. We will still see an invoice if the client has given us partial payment. So we can see for our Carter's Pennington home, we have 2 outstanding invoices. For the Hilson's Pocono home, again, another invoice. The Carter's Brigantine Beach home, we have 1 invoice with a slight underpayment, leaving a nominal 28 cents of the balance due, and then we have a more traditional invoice where they paid us $1,000 and we still have a balance due of $943.74. And of course that's going to be total for the client themselves. If we look at that nominal underpayment, that's a fairly common occurrence. Now we could ask for the 28 cents for the client, but it may be more there might be a better service to simply remove that 28 cents. And that can be done by creating what we call an invoice adjustment. And that's a topic that's covered in our client invoices and billing reports webinar as well, where I go into great discussions on the process of invoicing in general. And if we look at our Hilson Pocono home transaction, that invoice is dated 2006. Well, our company didn't exist back then, so that's probably just a typo when we were creating the invoice. So in that case, I would want to credit that invoice and create with a proper date, because I probably didn't pay sales tax on it and a whole host of other issues. So another report that we generally have a very good grasp upon would be our aged accounts receivable report, because we certainly want to get our funds from our client. And if we find problematic transactions here, why are those undesirable? Few reasons. Allowing clients to maintain long balances for great periods of time really hinders our cash flow, and that can simply stifle the business flow in general. Any invoice that's on here that could be a duplicate or has an unpaid balance, we really want to remove that or ensure that it is properly paid. If it's a duplicate, it's overstating our value of our company by having an asset that doesn't truly exist, and further, it's overstating our net income by having revenue that doesn't truly exist. In the case of the Carter's Pennington home, these invoices are getting a little bit long overdue, so I may want to push them by sending them a statement report to get payment upon those invoices, again, to keep our cash flow going there. If we have to credit or reverse an invoice, if the invoice for the Pocono home is simply completely incorrect, reversing it will reduce my revenue and also correspondingly reduce our net income. So that would be something to consider as well. Plus, you would receive a credit on your sales tax report for that period if tax was due upon that invoice originally. So those are our 5 subsidiary journals. So we have discussed our 3 main overall financial reports: the income statement or profit and loss, the balance sheet, and the combination, quote unquote, of the two on the trial balance. And then on the balance sheet, we have our accounts for accounts receivable, accounts payable, open clients, client deposits, vendor deposit, and work in process, which all have their corresponding reports to review. Now, before we end today's webinar, let's just talk about a few other pieces of information that are commonly requested by the accounting professional for tax time. One of them, they're going to require all of your checking or banking statements quite commonly, which I tend to like to have those scanned and saved so I can easily email them to the accountant. And you can also do this similar with your checking reconciliations. So if you didn't save a copy of that as you reconcile your bank account, you can reprint them in Design Manager. So in Design Manager, if you go to your checkbook, under your Reconcile Cash, and if you select your cash checking account, there's a History button. From the History button, you can reprint any of your saved or previously recorded reconciliations and provide those to the accounting professional, and you can do the exact same with your credit cards. On the History button, you can reprint any of your credit card reconciliations, and the accountant professional will certainly like those as well. In Professional, you would go to your checkbook and reconcile, select the appropriate cash account, and hit the Reconcile button, and you can do your history from here, and the same with credit cards. Hit the Reconcile button, and we can do our history here as well. Another report commonly requested by the accounting professional would be our sales tax report. Now, I print that for every period, be it that you file your taxes once every 6 months, once every quarter, once every month. You run your sales tax report off of your accounts receivable reports, sales tax, and I may print the report for the entire year and provide that to the accountant so they can see all of the invoices that I had presumably requested and received sales tax upon, and did I indeed pay that amount to my to the appropriate sales tax authorities. A third report that I commonly provide or suggest to provide to accounting professionals is a full accounting inquiry. If we go under our General Ledger folder, Account Inquiry, by leaving my account range blank, that's telling Design Manager to show me all the accounts. You only want to enter a range if you're trying to narrow the scope of the report, and I would change my starting month to the beginning of the year. By clicking OK, I'm going to see every single transaction for every single account. And even in my very small consolidated demonstration data, that is 10 pages. For any sizable company, that could be thousands. So what I like to do is use the export feature in Design Manager by clicking on the icon of the envelope with an arrow, select Export, click OK, and then under my report folder, I go to my year-end reports, and you can see that I have a few years already saved, and this would be my 2016 full account. And just like that, I have a nice PDF version of it to again send over to the accounting professional. And that will show them every single transaction that you've entered in Design Manager for the entire year for their analysis. Lastly, 1099s. If we have a subcontractor or anyone who does work for us that currently exceeds, we have paid over $600, we need to provide them a 1099. That documentation is under our accounts payable, and we can see our 1099 report. And we can run the summary report, the detailed forms, etc. Now, as 1099s are going to be due to our vendors and subcontractors quite soon, we have collaborated with our representative from our 1099 document provider, Nelco, and our representative is Jason Jennison. And On Thursday, January 5th, we have a collaborative webinar with Jason, where he will talk about the 1099s in general and the benefits of having assistance in doing so. And I'll talk about how to process the reports in Design Manager. So be sure to sign up for that report that webinar in early January, so you'll have a full explanation and everything you need to have your 1099s created properly. And that brings us to our end of our discussion of year-end reports. I hope some of you are inspired to get into your Design Manager and start reviewing these reports to get prepared for the upcoming tax time. Remember, any of the detailed discussion on topics we discussed today, work in process, fixing common accounting errors, invoicing your client, etc., be sure to go to our Help Center and our webinars page to review them there, or our YouTube page at Design Manager Inc. to review them there as well. With that, thank you for joining us. I hope that you join us again soon, and have a great day.